Good afternoon. My name is Michael Corselli. I'm the founder and chairman of FLYA. Today, I want to welcome everyone to our webcast, which will be hosted by Guillermo Bauder, portfolio manager of Clarion Asset Management. He will be leading our conversation today covering Clarion Asset Management's history of investing in global emerging market debt and why there are investment opportunities right now in this particular space. Guillermo has over 28 years of experience investing in emerging markets. A little bit about Clarion Asset Management. Clarion is a specialized asset manager with a focus on global high-yield emerging market fixed income. The firm was born from over 20 years of management experience with fixed income, leveraged on a lifetime developing global relationships in the emerging world. They have launched the Clarion Global Emerging Markets Bond Fund in congruence with their origins, network, and experience and expertise to capitalize on opportunities in the international debt markets. A little bit about Guillermo. He is the portfolio manager of Clarion's Global Emerging Market Bond Fund. He began his career in 1993 as a floor broker on the Caracas Stock Exchange, working at the broker-dealer of Grupo Confinanzas while studying business administration at the Universidad Metropolitana de Caracas. He later transferred to the local fixed income area and thereafter to the international fixed income area. In 1998, he moved to Peru and became a foreign associate for North American institutional brokers covering their institutional clients. In 2000, he joined FTC Securities as a foreign associate for Latin America, in charge with developing U.S. equity and fixed income for institutional clients. In 2003, he joined forces with Convencao, a Brazilian broker-dealer, to develop their international division, offering futures, commodities, U.S. equities, and international fixed income to institutional clients. At this time, I'd like to turn the presentation over to Guillermo, who will be covering global emerging market bonds. Guillermo?
Michael, thank you very much for your introduction. I would like to thank everybody who is giving me their precious time to hear our humble opinion about the markets, and I would like to guide you through our view of what we're seeing in this space, how it was born, where it's headed, and the opportunities that we're going to be seeing there. We founded Clarion in 2015 after being in the market space for quite a while. We will be covering also the history of the market, the challenges ahead, opportunities and risks, the active strategy we like to take in this scenario, investment cases, processes, active management funds versus benchmarks, or other leading ETFs. Okay, this has been a recollection of 30 years of experience. We currently have over $100 million in assets with 4 years track record, over 40 clients, and an experienced team to help us navigate through this difficult process. This asset class, although very old, started in the early 80s in the Napoleonic Wars. It only really started developing with the Brady bonds plan in 1989. These bonds later matured in the period between 2003 2007 and gave birth to what we know as the sovereign bonds today, basically extracting the US Treasury collateral they had at the time. During this period, 2003 2007, spreads closed very tightly and open space for companies in different countries to start tapping into the market. So the corporate market starts to develop very intensely around this time. Today, it has grown dramatically. We have over $4 trillion in US denominated debt, exposed to over 100 countries from around 70 sectors, in over 200 countries, and 2,000 companies, I'm sorry. You can see here in this chart the main countries as issuer size. Okay, Brazil being LATAM was probably the one that started leading this process, but then later China took over, and China is definitely the leader today. Basically, below here in the chart, you can see the top sectors is a market dominated by banks, sovereigns, real estate, financial services, oil and gas, metals, etc. And here to the right, you can see some of the top tier issuers like Saudi Arabia, Pemex, Abu Dhabi, Oman, Petrobras. So you have a lot of large sovereigns and also large semi-sovereigns being the top issuers within the space. The market recently has changed a lot with near $15 trillion in debt trading on negative yield. So this is an unprecedented situation, which is going to probably maintain the yielding asset class well bidded as investors go after yield. In today's world, we are in a very challenging scenario. We have presidential election coming through, which historically has always been a source of volatility and stress. The situation between US and China only deteriorated with all the COVID situation and can turn to one side or the other depending on the presidential elections. We have rising default risk next year. We have the second wave of coronavirus starting. We have been seeing an uneven recovery through the different countries and sectors, which we will address later on. With all this distress, political risks increase, and last but not least, still have the Brexit situation pending. So, as mentioned, we have this fellow.
Guillermo, yes. There's a question that popped up. It says it's from a family office. Do you think the emerging countries will be able to deal with a potential second wave of COVID? And how will you navigate it if the second wave of coronavirus materializes?
Well, the economies all the economies are suffering, and the countries are trying to bring their economies back. They have gone through intense expenses to attend the healthcare situation and support their economy, and at the same time having a fiscal situation on the drop of fiscal income. So the political and economical response will vary from one country to the other. You have, for example, small economies that have requested already support from the IMF, while you have some other stronger economies, for example, like Mexico, that have chosen not to use their firepower to support their economy. So the smaller economies seem to be a little bit more exposed than the larger ones. We have done our homework through March and April, understanding the effects to the market, performing a stress test to measure the situations that the companies will be living through in a 3-month or 6-month quarantine to identify who will come out or who will come on a very bad situation. For example, 1 week of lockdowns for Brazil represents something like 1.2% of loss of GDP. So every week that we're in lockdown it will impact economies dramatically. So we have simulated balance sheet projections for the companies that we're looking at all the way to the end of 2021. I think it is important to look forward and see how the world is going to be coming out and looking in 2021 once we pass 2020. 2020 seems like a year to survive, so we're very focused on seeing who is going to survive this lockdown. And On that regard, we took special care of seeing companies that were preserving cash, that had the proper liquidity, companies that had exports that could benefit from weaker currencies, companies that had a competitive edge versus their peers, definitely companies with good balance sheets or sovereign support. Um, and we've basically been moving up on the credit quality. So looking towards more towards the BB space and a little bit towards the triple B space, and a little bit further away from the single B space, taking a very selective approach. Is where very big opportunities are, but it's also where the risk is. So basically recovery is going to be very different for countries and companies and sectors. Okay, we will go through, as we go through the presentation, I will show you a little bit of that. But so going back to the presentation, you can see here what the expected default rates for March 2021 are today. Okay, this is data released by S&P. So we see that we are going to be, we can expect higher default rates. This is a challenging situation, and it will be key to be on the front line and really understanding the balance sheets and the situations for each company. So an active management approach will prove very helpful here. This other chart shows you the risks and opportunities in emerging markets and how the fiscal response varies, and indicated recovery will be uneven for one and another, a little bit of what we were talking before. So for example, you have China here, which stands on the front end, having positive growth and a modest support to their economy. Versus you have here on the other end, Peru, which is suffering a lot on their GDP forecast, and also have gone to a length of strong support in order not to lose that much. Then you can see here downside here, Mexico, where their economy is suffering, but they have been very, very fiscally responsible so far. So they have a lot of firepower that they can use to help their economy further. So this is what I was telling you before, that the situations for the different countries change a lot. It's not standardized for everybody. It's not the same. In the case here of Brazil, revision has already put Brazil further back towards the -10. So you can see some situations like that. Okay, here is another way of looking at more or less the same thing. So you can see that who has managed better COVID has a better chance of regaining traction easier. Asia seems to be doing a fairly good job in the COVID management. Europe so-so, MENA so-so, and Latin America doesn't seem to be on the good side. Brazil is suffering a lot from COVID. Then on the fiscal standing, you see there's also a big differential between Asia and the rest of the continents. On the monetary policy side, you see they're basically all aligned. They're all basically supporting their economies, some more than others, but all are more or less supportive. The drop on oil will impact some economies different than others. So you see China and Asia will be benefiting from lower oils, while MENA, Brazil, and Mexico are going to be suffering from lower oil, and Russia as well. Okay, each of the countries has their different challenges. So China has a huge debt burden situation. They have created an enormous debt through the years. Then Turkey has been seeing a lot of capital outflows. They have a currency issue with lower interest rates and policy and central bank being manipulated by the government. So they have their own situation there. Argentina was in the middle of a restructuring process, or is still in the middle of a restructuring process. Mexico is dealing with a huge, enormous debt problem with Pemex. So each of the countries have their own challenges, okay? You see here the growth forecast for 2020, but the more importantly, what we're focusing more our attention is on where the world is going to be going in 2021. So we see here China seems to be providing good growth, India as well. So we're going to be looking forward when we position ourselves on what's going on in the countries, on the sectors, and obviously on the companies, because it's going to be very different for some of them.
Guillermo,
Here,
I apologize. I don't mean to interrupt, but we're getting some questions in through the Q&A function.
go ahead.
A registered investment advisor in Miami asking which sectors could do well in second half of 2020, and why do you think this is the case?
Well, timing is perfect. I was just about to talk about that here. So you have some sectors that are suffering less, okay? For example, telecommunications is something that has kept on going. Consuming of food is something that has been kept on going. So the effect of the COVID lockdowns is been different for many sectors, okay? Then on the other side, you see, for example, transportation is suffering a lot, gaming is suffering a lot, oil and gas has been suffering a lot, okay? But we'll find another chart that will help respond that question in a second. Okay, so this here can show you visually more or less where all the sectors stand. So you see here the earnings potential impact on this side here. So these guys, let's say on the first quarter, are the less impacted, and over here are the guys that are going to be the most impacted. Okay. To responding to your advisor's questions, here we have established more or less how the recovery is expected today. So retail, grocery, essentials, telecom seem to be going back to normal by first half of 2021. Then technology, consumer products, pharmaceuticals should be recovering and back to normal levels by end of 2021. Whereas the utilities, the real estate sector, capital goods, chemicals, gaming, metals, buildings, banks, and financial services is going to be taking longer, and we'll probably only see them going back to normal by 2022. And then you have the sectors that are going to be suffering the most, which is the oil and gas, the automobile, transportation, like airlines, and those type of businesses that they'll only see full recovery probably after 2023. So you see the relationship changes from one another. But there is opportunities in all the sectors at the current stage. For example, we have taken exposure to good large oil gas companies that we know we have some sovereign state support, and they have low cost of productions, and then they can navigate fairly well in this scenario. Okay, but we have avoided automobile and transportation. On the same part, we took good exposure to pharmaceuticals. This traded out very good. They recovered steeply. We now rotated a little bit from them towards other places where we believe there is more value. Okay. Here is a chart that can show us a little bit how the market has performed over time. So you can see here clearly the 2008 crisis, how we went through it, and then slowly market continued to go up. This time around, although it's a very different crisis, and we're seeing a loss of revenue and a loss of demand, supply and demand on both sides, and the fundamentals are totally different. We could expect that at some points market will continue to recover. Okay. This shows it in another format. You can see how we suffered in 2008, a similar drop of the one we suffered today, only to recover a year later. Okay. We will be covering the situation of liquidity, but with the extreme liquidity we have today in the markets, unless there is a very dramatic event, slowly we should continue to recover. Okay. There's a situation that came lately on the markets, stressing many investors regarding inflation. So the first thing I think to say is that we know from Milton Friedman that inflation is always and everywhere a monetary phenomena. Okay, investors have been concerned with the recent jump of the spread between the 2-year and the 10-year. Okay, and the surge on the monetary base. Okay, so you can see here, this chart here shows us the monetary base increase and how inflation is behaving. Okay, important to show that velocity is being dropping dramatically. Okay, so this is what started generating inflation concerns lately. So this was a relationship spread between the 10-year and the 2-year, which recently just jumped, okay, raising concerns that inflation would be coming back. Our specialized sources are of the belief that their studies are showing that the volatility that followed the reopening of the economy is what we're seeing and not inflation. Okay, and you can see here the charts indicating that volatility, okay, where many of the indexes are still stable. So they're of the belief that US inflation is not going to be there for a while. If you see the history chart for inflation, we're still far from the 2% target the Fed has set. And we can also expect for them to be, let's say, a little bit relaxed about that target and letting inflation go through a little bit, as we might see some volatility through the process. But for now, we're not expecting inflation to be back until after the vaccine of the coronavirus is in place. Okay, here is some other information that we have seen from our sources that is interesting, and is that inflation is very affected by wage growth and housing data. Okay, wage growth. So wages and housing contribute significantly in the inflation equation, and wage growth lags earnings by 12 months. Okay, so what they're saying is basically that the wages will be lagging 12 months the impact of the coronavirus and the earnings that we're going to be seeing dropping. Okay, and that inflation impact will be only seeing it 12 months down the road. So we are still going to be seeing the bottoming on inflation from their point of view around mid-2021. Okay, you see also here the housing data is also pointing on the weaker side. So these two elements have a very important weight on the inflation equation. There's another interesting piece of material, which is that US recovery seems stalling, while EM recovery has been underway. You can see here that the US started recovering pretty steeply until May, and since May it has been stalling. So this stabilization or stalling could imply that we might get a larger stimulus package from the government in order to continue to boost their economy and try to bring it back on track. Okay. On the positive side, emerging market economies have been continuing to recovery. They're showing a little bit of stalling here in August. So I would not be surprised if also our governments see more supportive by cutting interest rates and more support to the economy. Okay, we are in a scenario where definitely we're going to be seeing lower for longer yields, okay? And this is going to trigger investor appetite. So if we have inflation still under control, if we have excess liquidity in the markets, and if we have low yields for a while, this definitely seems that is going to be supportive for the asset class, okay? So we're expecting that asset classes will continue to be supported. If you look at the Fed's balance sheet projections, today it was running around something like 7.7. I will try to show you just 1 second. This is not on the chart, but I think it's important. Okay, so here. So this is the balance sheet projections for the Fed, for the central bank. And you see how we're here in 2020 and where it is expected to go by 2021 and still 2022. So we are under the impression that this excess liquidity and support is going to continue, okay, giving still support to our asset class. Then here is the relationship of the EM central banks interest rates and how they have been cutting their rates further and further and further. So you see their bank rate here now running at around 4, which is the historical low since 2008. And you see here the blue, softer blue line where the cumulative cuts are increasing. Okay, so we will not be surprised if we continue to see lower rates and increasing cuts from the central banks in emerging markets trying to support their economies as well.
Guillermo, we've had a couple of questions that have come in, and I
Go
think
ahead.
that you've answered some of them already.
Go ahead. I'm sorry.
But maybe you can just quickly. This gentleman's asking about inflation, which I know you covered a little while back. Do you think if inflation will be back soon? And what's your date for inflation in the U.S.?
Well, I'm not an inflation specialist. We have specialists to help us with that. Their analysis suggests that inflation is going to be low for a while. That we're going to be seeing inflation back around mid 21 and further, at least. If you see the drop of earnings, there is no wage growth to be anticipated. And wage growth is probably going to be lower in 2021. So this is going to definitely play on the weaker side of inflation. Okay, the same thing as rental wages is also going to play a very supportive or maintaining inflation low. Then personally, I believe we are in long-term disinflationary trend that comes from the changes in technologies and governments having to cut through huge costs to be more competitive. So you have seen scenarios like Uber, where people are buying less cars. You have seen scenarios like the one we're using now, where you're having the technology of telecommunications, seeing cut on expenses. So there, all these technological changes are providing a disinflationary trend, okay? And although there has been a huge amount of printing, the relationship with all this money hasn't been used as fast. So the economies are still slowing down, okay? So we are not, for what I understand from our specialized sources, we are not expecting inflation to go back anytime soon before mid 2021, more or less.
All right, and then on a follow-up question, which it touches a different part of the similar question. there's a single family office out of Texas asking, will financial markets continue to ignore economic fundamentals?
Okay, so the fundamentals are, as we said, are different for many sectors and countries and companies. We will probably see some sectors and companies and countries having more pain than others. But as a general factor, as we see a a wide level of liquidity, this is definitely going to be very supportive for the overall asset classes. Okay, and I will bring back the chart I showed you guys a little while ago. This one here. So basically, unless we have a dramatical event with this huge liquidity that is projected to still be hitting the market, we could be expecting the asset class in general to be supportive. That doesn't mean a company here or there or a sector here or there is not going to be in trouble. They are, as we said also in the presentation, and I will go back. You can expect, just 1 second. As we can go back, you could expect here. So as we said at the beginning, you can expect default rates going up next year. Okay, so what I'm saying is you're going to have some guys failing, but the overall market should be supportive. Okay, with this extreme liquidity, unless you have a dramatic event. Okay, which we're not foreseeing as of now. I hope this answers the question.
Yes, thank you.
Okay,
and I want to remind everybody that they can use
yeah.
the Q&A function in the Zoom toolbar to ask questions, or the chat function to ask questions.
Okay, so going back to where we were, this chart here shows a little bit of the floats toward emerging markets. So you can see here in March, we had a huge withdrawal of assets. International Institute of Finance estimates it to be around 90 billion that came out of March. But after that, we have seen slowly assets recovering. This line here shows the average historical level of flows, and now we just crossed it. So it seems like investors are getting more confident with the emerging market and slowly are continuing to return and put flows to work in this space. And we expect the situation to continue, okay? Here, for example, touching a little bit of some of the key assets for emerging market, you have the oil price situation. So PEP has been doing some cuts, supporting the prices. We had a huge slump during the crisis. Asset prices are slowly recovering. I believe they're trading around 42. They're expected to still continue to recover on several factors. On one side, the cuts. On the second side, the economy is slowly starting to demand a little bit more. And also, we have to remember that these assets trade in dollars. So as dollars get weaker, prices also go up for them, okay? Here you can see on this side, the manufacturing PMI is improving. So this is the part that I was saying that is supportive for these prices. So we expect these prices to be slowly stabilizing towards the 50-ish area, okay? Providing some comfort to companies. We have seen oil companies with break-even levels around the 35, and the weaker ones around the 40s. So slowly the situation is improving, okay? So as I said before, a weak US dollar favors commodities, and then stronger prices of commodities favor companies that are exporting these commodities, as they have local currencies that have suffered a lot, and they get benefited by selling their commodities at higher prices. So we slowly are seeing commodity prices recovering on The PMI is slowly improving, and the dollar weakness is proving their prices. So markets are slowly moving towards stabilization. Okay.
So, Guillermo, you have a question. I think this is a good time to take this question.
Go ahead.
So what could the impact of the U.S. Dollar appreciation or depreciation be in your strategy? Because as you know, the emerging debt countries tend to perform better in a period of U.S. dollar depreciation.
Correct. So with U.S. printing, dollars has seen a little bit of weakening, and this has played to counteract on the FX side the printing coming from emerging markets countries. So if, let's say, Europe is printing and U.S. is printing, the FX shouldn't move that much on one side. In the case of emerging markets, the emerging market currency suffered a lot initially, but then tended to stabilize. So if this dollar situation continues to print and dollar continues to weaken, we can see their effects coming into a stronger side, which can play positively on their balance sheets. Of many of them have dollar denominated debt, and on the other side, the exporters could see their commodity prices going up. So they can benefit from that. If their local currencies were to weaken, this would play out negatively for the ones that are not exporters, because they will see on their balance sheets their debt increasing because of the FX situation, but they will not have the benefit of the export and having benefiting from local currency. So it will affect some companies positively and it will affect some companies negatively. Okay, so it's important to try to identify this movement, and we have been, for example, favoring exporters that will benefit from stronger prices in commodities, and could benefit if their local currencies have weakened a lot, can benefit from this extra income while having cost in local currencies. Okay. Okay, so let's continue. So debt has been resilient through this time. So emerging market debt has been resilient to this time. We saw this is the average spread between US and high yield and emerging market debt. We saw some widening here, which were definitely emerging markets suffered dramatically more than US. We're seeing a little bit like a more high beta play than the US debt. So when the markets entered in crisis, we suffered a lot. But then probably when the Q&Es started to hit the market, we benefited a little bit from those dynamics of this excess liquidity, and spreads slowly starting to come back. Okay. On the positive side, emerging market companies since 2008 have been working to reduce debt. So I think that has played out as a positive factor as well. Okay, so we expect demand to continue high towards emerging market debt, and to continue to try to identify opportunities within the space. The investment grade space is definitely tightened a lot, but the BB space and the single B space still offers a lot of opportunities. We can see that here in this chart here. So you see the widening of the spreads, how they went in the March crisis, and slowly how they are recovering, coming back. But you see that there is still a long way to go to the minimums of 2018, 2010, 2006. So although the situation seems tight in many bonds, especially the investment grade space, you see here that there is a space for tightening, especially on the BB space and on the single B space. There you can find important yields, very attractive, especially if compared to the developed economies. Okay,
so there's a comparison question here. It's from a pension fund, public pension fund in Florida. Gentleman wants to know, how do you see today's prices of the bonds in the high yield sector in the U.S. versus high yield sector in emerging markets? He's looking for in terms of potential price appreciation.
Well, I'm not a specialist in the U.S. space, so it's difficult for me to respond about the U.S. space. But emerging markets has definitely space for price appreciation, especially on the case of riskier assets. So the markets have been very quick to react and to go and buy the usual suspects, the large companies, the companies that have good balance sheets. Those companies have gone up pretty quick and they're trading pretty tight. But then when you go a little bit further down, the BB credits, there's a little bit of widening still to come back to the highs of pre-COVID situation. And if you go down the credit spectrum to the single B space, you'll be amazed of the yields you can find. You're talking about 20%, 30% yields. Of course, there is risk. So there's a lot of due diligence to be done. It's not just a quick buy in and out situation. You really need to understand the dynamics of the country, of the sector, of the credits, but there is a lot of opportunity. You're talking, you see yields on the 20-ish, 30-ish, and then you have on the other side, on the BB space, you can find some companies paying 8, 9%. So there is space for some widenings here and there, but there is risk. So it is there is a need to address these opportunities with a lot of knowledge of what's going on and be very selective to buy into the right ones and not get exposed through the statistics where you see default rates going up.
Okay, I have one question here from a gentleman. He wants to understand how your firm is leveraging technology to mitigate risk in today's investment environment. And he says, "Thank you for your great presentation."
We are a long only UCITS funds. So the structure of the fund does not allow the fund to leverage. We cannot leverage the portfolio. So the portfolio today is just one bond beside the other with no leverage. And we only can use derivatives for hedging currencies for the currency share classes. So we have a share class in dollars for the case of our fund. We have a share class in euros. So for this share class in euros, we use the hedging of the currency to convert it to euros, but we don't use leverage within the portfolio itself. We're not allowed to do that, unfortunately.
All right, maybe we can come back to that question. His question's more of how are you using technology to manage risk in the portfolio, like how. But we could come back to that question.
Okay. So looking into where we were seeing opportunities, we are seeing that today there is around $140 billion of debt, which are in negative watch. Okay, you see it around here, which is investment grade. This is what they call the falling angels. So when you have investors in the investment grade space, the pool of liquidity they have is huge. When you get out of this investment grade space and you fall into the high yield, the liquidity drops probably to 10% of the liquidity that the investment grade space has. So, but by losing your investment grade space, these companies usually tend to suffer outflows, and these outflows sometimes trigger price momentums that are steeper than their actual risk is. Okay, providing very good entry points for active managers that are in the front line looking at these opportunities and trying to enter the market at the right timing and take advantage of good quality risks, but where there's a premium because of the liquidity loss. Okay, but still buying into companies that have healthy balance sheets and in most cases good businesses, and that will probably be struggling to go back to becoming an investment grade company in the years ahead. And this will provide a very nice risk reward. So there's going to be a lot of opportunities within this space going forward, and it's going to be interesting to try to take advantage of them. Okay, this is something that we're looking at. Another way to show you a little bit what this means through this chart. This is the rate of default from Standard & Poor's for the different ratings that we're seeing. So when you're looking at the lowest part of investment grade for, let's say, a horizon of 5 years, your rate of default risk is around 2.6. Okay, so when you drop and you go into the BB space, your rate of default increased marginally from 2.6 to 3.5. But in this area here, you will be able maybe to collect 200, 300 basis points more than you will be able to collect here, especially if you capture the right momentum when on the trading side, when the investment grade is being lost and flows of investment grade investors are pushing prices down, it could be a very interesting trade. So there's going to be a lot of opportunities over there with a relatively healthy risk. Okay, there are a lot of opportunities, as I said, also within the BB space, but then you're taking a little bit of risk, and even more in the single B space, but you're still taking a little bit more risk. So it is going to demand a very good grip on the credit analysis, sector analysis, country analysis, and understanding very well where you're going in. Okay, especially because liquidity here is more of an issue as well. Okay, this is more or less a little bit of what I've been saying. So the way we look at the investment process, this is a macro scenario. So we're going to be looking at it from the top-down perspective, looking at the global macro situation, interest rates, inflation, etc. Then the country sector outlook, then geopolitics of each country, and what's happening. Then on the sector, how the sectors are developing and where they're headed. Finally, going into the credit analysis, and then taking the end decision. This is more or less how many of the decisions are taken, but we can also do sometimes a specific bottom up situations where you have an event that happened in a specific companies generating huge distress, and then we can stop and see the specific company, what's going on, the sector, the geopolitics of the country where it is, and if it's a interesting play to go in. So you can play it both ways many times. It's interesting to have an active management approach versus going through the benchmarks. You see that it can play out in the long term very positively. Okay, the same thing against leading ETFs, where you have a static relationship. So going forward, I think this is going to be even more important as rate of defaults are going to be increasing, and this is going to have a very negative impact in the portfolios. Okay. Today, our main players of the team would be us three. I'm the portfolio manager. Gabriel is our chief strategist. Arturo helps me in research and support. We also have two credit analysts that are part of the team, a trader and portfolio oversight responsible person, plus an administration team. So this is more or less our setup of our structure today. We're based in Brazil. You're welcome to come and visit us anytime, or shoot me an email and let me know any inquiries, any questions. We're very accessible. I hope you have taken some advantage of the time you have given us, and please feel free to contact me with any questions. Thank you, Michael, for organizing this.
Arturo, there's a couple of questions that have come in relation to generating alpha. And I know you touched on this,
Okay.
but do you mind going back over how you pick up alpha versus a passive strategy of just buying and holding the bonds?
Sure. For example, a way to pick up alpha is, for example, identifying a good company in a country that has a very difficult situation. So the company is usually going to paying us a premium because it's been in this country, but the company might be a very good company and, for example, an exporter that gets less impacted by the situations of the country. So there could be, okay, or also finding companies that are in a more difficult situation but are in a very healthy and very supportive country, so we can maybe decide to take some credit risk there, or some sector risk there. So there's going to be different ways to play alpha. We can also, in terms of macro, extend the portfolio's duration, reduce the portfolio's duration, increase the quantity of papers that we have in the lower, higher beta space, or decrease it. So there's ways we can move around in order to try to achieve a better performance or reduce risk in scenarios of stress. We can also go to cash on a percentage of the portfolio. This will provide some stability.
So there's a question that came in. Do you invest in EM asset-backed securities? Do you think of EM ABS as a component of the EM bond asset class?
We unfortunately do not participate in that market. We only buy emerging market dollar denominated offshore debt, both corporate, sovereign, and semi-sovereign. We are on our prospectus subject also to some liquidity constraints where we cannot buy bonds that are smaller than $100 million. Liquidity in the latest years after 2008 has become an issue. So we are we're very concerned with liquidity. We're always trying to improve the liquidity of the portfolio overall, although sometimes we need to buy lower size bonds. But no, we do not participate in those bonds.
All right, we have another question that's come up. What is the expected coupon return of the fund looking forward? Do you have a class that pays a fixed coupon distribution for the income-oriented investor?
Yes, the portfolio currently is running at a coupon of 6.5%. And we have an asset class that distributes 6% per year on a quarterly basis.
Okay. 6% per year. I believe that I answered that question. Gentleman's asking, what is their typical estimated turnover for the portfolio?
I would say we make around one trade per week. So we're not on the business of trading constantly on the events. We're more of a fundamental view, trying to identify assets that have quality and then sit down and stick to them for a long time. Sometimes this is a shorter movement, or we're forced to change the overall strategy of the portfolio, and we will exit some bonds, not because we don't like them, but because we need to increase cash levels or reduce the duration or situations like that. So I would say that we trade the portfolio maximum once per year.
One turn on the portfolio per year. And
Yeah.
the idea is, so basically your holding period for each of the maturities is roughly 12 months?
Well, the thing is, we will have to go in and out of some bonds during the year, and some other bonds we are holding in for several years. So when you add them one with the others, we might come up to a number where we may be turning the portfolio around once a year. Our focus is not how much we turn the portfolio, and yes, that we find the best risk reward for it. So we will be focusing on finding opportunities where the risk reward is very good, and let them run until this risk reward is not that good. For example, I exited a pharmaceutical company, which I like very much, which I like the sector very much, which I like everything very much. But when we entered, it was trading around at 8%, and when we exited, it was trading around 3.5%. So it had gotten pretty expensive. It had a nice coupon, so we held for it for a long time. But at some point, it just got expensive, and there were better opportunities away. So we decided to roll out and try to look for something for a new opportunity away.
So this gentleman's asking about duration. What's your target duration in the portfolio, and how long, how short do you go with regards to duration?
We usually have a range, let's say between 3 and 5. So when we are navigating on the extended duration, we are going to be near the 4.5 to 5%, 5 duration. And we're navigating on the shorter duration space, we're going to be running around the 3.5 duration. Okay.
And he is also asking if you're using perpetuals in the portfolio.
We are not so fan of perpetuals. Okay. So here you can see the duration of the portfolio. Today is at 4.6 and the coupon is at 6.4.
It didn't, the screen didn't change.
Oh, I'm sorry. Did it change now?
No, it did not.
Okay. But anyway, duration currently is at 4.6. So what I'm trying to say is we're not uncomfortable with the duration scenario. As I said, we expect liquidity to continue wide. We expect flows to continue wide. We expect rates to continue low, and we expect inflation to continue under control. And we see the recent jump on the spread between the 2 and 10-year treasury spreads to be a momentary situation because of the reopening generating volatility.
All right. I believe there's a couple more questions. However, we are out of time. And Guillermo, I want to thank you for, introducing us to your firm, Clarion. It's a very impressive firm that you've built with your team, and introducing us to the opportunity to invest in emerging market debt. I wanted to highlight that the strategies available in separately managed accounts or directly into the LP fund, Clarion Global Emerging Market Bond Fund, or through the usage structure, which has daily liquidity. We will be sending out information in the next couple of days on how you can contact Guillermo Arturo, the team at Clarion, to further discuss, an investment or potential investment opportunity. But in the meantime, you can check out their website. It's clarionasset.com, CLARION asset, ASSAT.com. You can also go to the Flyer website and look at their marketplace listing. But we will be reaching back out to everybody who attended today's webcast. And once again, thank you to Clarion. Thank you to all the participants today. Have a great day.
Thank you, Michael. Thank you, everybody, for assisting me. And please feel free to contact me via email or phone. Bye-bye.
Bye now.